Hey guys, in this video, we're going to talk about cost segregation. All right, let's get started. So if you've been wondering what the heck people are talking about when they say cost segregation, they're talking about this. Putting more money back in their pocket. They're talking about taking their assets, their residential real estate, their commercial real estate, and accelerating the depreciation. Now, if you're not aware of it, which you should be, when you buy real estate, the reason they call it a tax shelter to some extent is the fact that you're able to depreciate the property. In fact, you're supposed to depreciate the property. And depending on the type of asset you buy, commercial or residential, you have different straight line depreciation years. For example, if it's a commercial property, it's going to be 39 years. If it's a residential property, it's 27 and a half years. And so what they look at when they're depreciating property is, let's say you bought a piece of property for $400,000. Okay, so this is your rental house, it's residential. Now you're going to subtract out the value of the land. Your CPA would do this. And let's assume that the value of the land was $75,000. So that's going to leave you with an asset value, the structures, at $325,000. Okay? This is what we're going to be depreciating. So if you did it on a straight line depreciation, which is the way most people always do it, you would take 325, divide it by 27 and a half years, and you would come up with about $11,800 a year in depreciation. That means that the value of that asset is declining over time as someone continues to live there, and it's going to have to be replaced eventually. So, how does this factor into my taxes? Well, let's assume that this property generates for me on this particular year $28,000 in income. Well, when I take that income and I take all my other expenses against it, let's say that brings me down now to $24,000 in income. Now, I don't have to pay taxes on that full amount, even though that went into my bank account, because this Mr. Depreciation is going to come up here, and I'm going to be able to write off $11,800 against that $24,000 in income. So really now I'm going to be paying taxes on $12,200. So I put $11,800 into my bank. It was completely tax-free. So that's how standard depreciation works. Well, up comes now cost segregation, which is accelerated depreciation. And what does that mean? Well, accelerated depreciation, what we're going to do is we're going to look at this asset and we're going to say, yeah, it's a house, but a house is comprised of many different things. It has cabinets, it has fixtures, it has appliances, it has landscaping, right? It has carpet, paint. And so we're going to break all of those things out, basically disassemble the house and say, you know what? Some of those things, they're going to wear out a lot quicker. And so if we can show that they're going to wear out a lot quicker, then that means we don't have to depreciate them over 27 and a half years. We can put them on a different depreciation schedule. And the IRS lays out some different depreciation schedules for assets based upon their useful life and what category they fall into. So with cost segregation, what you're looking to do is you're looking to take this asset and turn that number into something more. And the reason you want to do this is because now, if we were to take this, and let's say in this example here, I have performed a cost seg study on it. They look at that, and with the bonus depreciation right now that you're still allowed to take on that, I run my cost segregation study, and they say, you know what, this year you get an extra $50K. So if I put on an extra $50,000, I now have $61,000 in depreciation. This is what we're talking about, how real estate can really put a lot of money back in your pocket if you know how to work the tax code in your favor. So you have this study done typically by someone who's a cost segregation expert. We use companies such as Cost Segregation Authority to do this. But they'll come in, they'll look at your property, and they'll run through some calculations. Maybe they send someone out to it, and they do an analysis, and they come back and they give you a number, and they go, this is what you're able to deduct. Now, what does that mean to me as a real estate investor? Well, it means that if I have passive income, because remember, real estate is a passive activity and you fall under the passive loss rules. So this $61,000 is only beneficial to me if I have at least $61,000 in passive income. Well, obviously on this property, I had $24,000 in passive income. So 24 from the 61, that puts you at what, $36,000? Well, $37,000, something like that. So you're at 37,000 of losses that go unused. So what are you going to do with those losses? Well, we don't want to be in a situation where we have unused losses, you know. So again, my example, 24,000 from this property, $64,000 in losses for depreciation, puts you at or 61,000. Okay, it puts you at 37K. Just back that. Hopefully, I'm doing my math right there. So I'm at 37K in losses. So these would just get basically suspended. But if I have other income from other activities, passive activities, rental income, let's say I had 3 more properties that are generating this $12,000 after their standard depreciation, well, I could take that 36, remember 3 times 12 because they each get their standard. I could take that $36,000 over here onto this line, and now I only have $1,000 in loss that I carry forwards. But what I did is I took $24,000 in income from this property. I took a combined $36,000 of taxable income after the standard depreciation applied to my other 3 properties, and I paid 0 tax on it. So essentially in this example that I just showed you, you earned $60,000 tax-free. Okay, this is the benefit of performing this type of strategy in owning rental real estate. Now, these numbers get even better when you have certain types of properties, and it gets even better if you're a real estate professional, because I was just explaining to you that you have to have passive income. Now, maybe you have real estate that doesn't produce a lot of passive income because you're chewing it up with all your deductions. So then what do? You become a real estate professional, and now you free up this. So this $37,000 up here, if I'm a real estate professional, I don't need to go look for passive income anymore to offset it against. I look for any income. So if my spouse is working and my spouse is bringing in $100,000 in W-2, okay, working for the state. Okay, we made $100,000. Well, let's take $37,000 up there, write that off against $100,000. So really I made $63,000. You see how these numbers can work out in your favor? And you don't have to do it all the first year. You can just stagger your properties. That's something that I do with my investing. I look at my taxes, do an analysis, and decide each and every year which properties I'm going to utilize for cost segregation to minimize my overall taxable income from my real estate investing. Because there's no sense in going out there and wiping it all out and having huge losses to carry forwards. So I try to match it up. Hey, this is something that's out there in the tax code, the bonus depreciation, which allows you to take these huge upfront deductions. That runs out in 2023, and then it starts to, actually it doesn't run out, it starts to decline after 2023 by 20% a year until 2026. So if you've got something like this in your portfolio, you may want to take advantage of it. In addition to that, I mean, this is how people can get into bigger deals, because you talk about the down payments that you have to put down to go into these larger deals. Well, if you perform a cost segregation study, that a lot of times that down payment, it's going to come from the tax savings you're going to get just from depreciating the property. So it covers your down on the real estate you're buying. Lots of planning around this, guys. If you're a real estate investor and you're active and you have the properties, make sure you're checking into this. Hey, make sure you subscribe to the channel as well if you like it, and you like the video, pound the like button. All right, take care, everyone.